For more on banks, let's bring in Gerard Cassidy, the head of U.S. Bank Equity Strategy at RBC. Gerard, great to have you with us. Did you find the Citi call as alarming as Karen did? And I'll put this question to you, which was posed on the call. Is Citi this year's Wells Fargo?
I would say no, it's not this year's Wells Fargo by any stretch of the imagination. The problems that Citi has, of course, are internal controls and procedure problems. Wells's problems were consumer, problems with their consumer customers, where those customers were hurt and damaged. So I would equate it more to you might recall the J.P. Morgan London Whale problem of about 7 or 8 years ago. That's I think, the more similar comparison. But it was disappointing. I mean, they certainly were asked consistently throughout the call about the expense number for working through these problems. They don't have their arms around it just yet. As part of the cease and desist order, they have about 120 days where they have to put their plan in place. They'll have an estimate, I think, by then, which means we'll probably get a fourth quarter number. But it's going to take time. It's going to be challenging on the cost side because revenues are under pressure for the industry, as the traders have been talking about. The interest rate environment has put pressure on that net interest margin for everyone, which is going to affect revenues in 2021.
Since you're making the comparison to the London Whale episode, Gerard, for J.P. Morgan, when that happened, did you as an analyst get a sense of how much that episode would cost J.P. Morgan and what sort of time frame? I'm just trying to understand if there is an appropriate valuation discount embedded in Citigroup shares right now, given we don't know the extent of the expense and we don't know the time frame in which this issue will be resolved.
No, that's a fair question, Melissa. And I would say that I think the stock has overreacted to the problems. You might remember when this first came out a couple of weeks ago, the stock traded down 2 days in a row. Obviously, it's underperformed again today. And don't get me wrong, the problems are serious, but they're fixable. And the big difference is that, again, this is not something where customers were damaged or hurt. And in the J.P. Morgan case, the losses were bigger just because they were trading losses, but it was a control and procedure issue there as well. And it was fixed rather quickly because it was more trading than it is with this issue when they have to, again, control the back office. It'll take time. These cease and desist orders are very powerful, and we will get a number. And we got to remember, too, that the company does have a lot of momentum in investment banking, which J.P. Morgan put up good numbers today. And like the guy said, we're going to see probably good numbers from Goldman and Morgan Stanley this week as well.
Karen, you got a question?
Yeah. Hi, Gerard. Thanks for being on. Let me ask you something about the pressure on the net interest margin. A lot of that was due to just an influx of deposits. Do you think they're going to be better able, either Citi or J.P. Morgan, to convert some of those deposits into anything higher yielding than the very shortest end of the curve?
Karen, you put your thumb on it. It's a unbelievable problem to have, and I can't believe I'm saying this, but there's too many deposits. The inflow into the banking system because of what the Federal Reserve has been doing has been extraordinary. As you all know, the balance sheet at the Fed is now close to $7 trillion. It was just under $4 trillion before the pandemic, and that money has to flow somewhere, and it's flowing into the banking system. Unfortunately, the banks do not have the loan demand to support that kind of deposit growth, and it has to go into very short-term assets, meaning sitting on the Fed's balance sheet, and it's costing them money, believe it or not, and it's really hurting the net interest margin. So we need to see that, believe it or not, deposits outflow or put them to work. But the banks are a little reluctant to do that because they don't want to go out on the yield curve and take that interest rate risk. So the pressure on the margin is not going to be alleviated, I don't think, anytime soon.
All right. Gerard, thanks for joining us. Great to hear from you. Gerard Cassidy of RBC. This is something that we haven't talked about, and that is the extrapolation of what the banks have said on the earnings call to the economy. And usually Jamie Dimon is sort of a good prognosticator on that. Tim, what was your takeaway?
Well, he certainly made a very clear plea for more support for the economy in terms of fiscal stimulus. So Jamie Dimon, I think, has always had a very kind of rational and sober look at the economy and the world, and I think that sent part of the message. And people know that banks ultimately are the ultimate barometer trade for the economy. We've talked on this show all the time, at least over the last 2 to 3 months, maybe 6 months, where the disconnect between the banking sector and the rest of the market either said there was something wrong in the assessment of the economy or frankly how healthy Main Street was and banks should be trading better. Maybe on some level today's temperature test by Jamie Dimon and to the extent either implicitly by Citibank was not all that bullish on the economy. Banks have played that story for the last 6 months.
Shepard Smith here. Thanks for watching CNBC on YouTube.